Not as fun as Method Man, but we'll try to make it entertaining. So I'm very fortunate to be able to moderate this panel. For those of you that know me, I'm super passionate about climate and addressing climate through the capital markets. I have a TV show on the floor of the New York Stock Exchange that you could see on fintech.tv, a wealth and asset management firm that builds model portfolios for climate, and host conferences on climate change all over the country. Next week, 2 in New York City, 1 on Wednesday at the New York Stock Exchange, 1 on Thursday at the Javits Center. So we do a lot in the area. And today we're going to focus on how to address climate change through the capital markets and why to address climate change through the capital markets. And the one thing I would say for people that are here but still kind of on the fence about climate change as an issue that's addressable through the capital markets, or that there's a need to address climate change through the capital markets. My way of coming at this started with reinsurance companies and learning through reinsurance companies back in 2015 that they were all at risk of not being profitable on their claims paying on natural disasters. And that was an open dialogue that they were willing to have with me, and that was every Munich Re, Swiss Re, every company you can go to and talk to. They were all employing climate scientists by 2015. And what do I say to people all the time that bring a political lens to climate change is that reinsurance companies have no politics. They only care about profit. They're not leaving California and leaving Florida and stopping insuring these states because they have some political agenda. They just want to make money, and they're not making money because of climate change. So that's a good place to start if you still really don't have a sense of climate change and how it's going to impact the capital markets. Okay, that's my spiel. I'm joined today by Rachel Robasciotti and Heather Beatty, and I'm super excited. I love both of these women. I will make a disclaimer that as a manager of managers, I prefer working with women managers a lot on climate, because I've found over the last 15 or 20 years that when things are changing and systems are changing, women have an ability to be more malleable and address and react and respond to that change. Older, pale, stale males, as I would lump myself into too, have a more difficult time accepting that the status quo is under a big shift, and they get more embedded a lot of times rather than becoming adaptable. So thank both of you for the work that you do. Start with short introductions. Heather?
Yeah, thanks for having me. So I've been in the industry for almost 20 years, and I noticed, clients began to ask about climate specifically as it relates to risk. But Scope 4, which is the organization that I founded and the CEO for, focuses 100% on climate solutions. And so that's really where we think the alpha opportunity is. And it's all about scaling climate solutions, and we can talk a lot about that in the public equity markets, because there's a lot of capital being pushed towards that, obviously through policy and through companies and countries that are committing to that. And then they're also going to be beneficiaries of that, as well as companies that are going to help draw down emissions, which is the ultimate goal.
Awesome. Rachel?
So I'm the CEO and founder of Adesina Social Capital. We are a public markets asset manager. We do social justice investing, and that includes racial, gender, economic, and climate justice. We think that those issues can't be pulled apart, and I'll talk more about that. And we're operating under this really basic thesis, which is that social justice movements, including climate justice movements, are giving us early indicators of risk that otherwise aren't priced into the market. So we are living out that investment thesis in our ETF and in our SMAs, and really delivering a lot of value to advisors whose clients are asking for those kinds of solutions.
So I'm going to stick with Rachel for the first question. A lot of advisors, and I spent the last 2 days having 24 meetings with advisors, which is great. I want to thank Future Proof for making really an atmosphere where it was easy to meet with lots of people, and everyone was super engaged about all of those meetings. So I think this is a great conference, and big shout out to Future Proof for the way they've organized this. Some of the questions that came up a lot in talking to advisors about climate change specifically, we'll address a bunch of them, but let's start with is climate change a risk opportunity or is it a opportunistic opportunity? And from what lens are you looking at it, or both potentially?
So I was in the wealth management business for 17 years. So I actually advised clients directly and built out a firm before transitioning to the second company, which is an asset management firm with Adesina. And we really approached it first from a risk perspective. When you look out at the future and you're trying to understand, how do I prepare this client for retirement, you're thinking about a future in which you're going to be living out the investment choices that we make today. And it felt like we were leaving something behind if we didn't include the fact that we could see broad-based disruptions in the social fabric and large disruptions beginning to happen in climate. And we felt like those who were closest to those problems, those who are generally represented by social justice movements on those issues, were going to give us the best intelligence. And that's what we started to look to them in order to build a strategy. So for us, it really was a risk management strategy. And in the end, if you're doing a good job of managing risk, you're really upholding your fiduciary duties. So that was the way that we approached it. And we're good friends with other asset managers like Scope 4, where we know that they're looking at those opportunities as well.
So Heather, let's stick with this question from a different perspective, maybe.
Yes, so I alluded to before that we do view it as an opportunity. And if you just kind of think about, I talked a little bit about the commitments that have been made. To put it in numbers, over 70 countries have committed to net zero, and that's up just a couple years ago from under 50. Over 5,000 public companies have also committed to net zero. And so the velocity of the commitment means that there's going to be trillions of dollars that are put to work. If you just look at renewable energy in general, $1 trillion went to renewables just in 2022. And if you look at that over the course of the last decade, that's up from literally $30 billion. But we don't think that renewable energy is 100% of the equation. I think oftentimes it turns into this binary discussion about, okay, we're pro-renewable energy and anti-oil and gas. But if you think about it from an investment opportunity standpoint, there's, of course, climate tech, which is oftentimes really pushed in the VC space. And I know a lot of you are considering that with your clients. But there's also the circular economy, so how we think about how we're dealing with waste. There's also green infrastructure, which is really important in terms of buildings and energy-efficient buildings. There's also what we call sustainable ecosystems, and that's about how we're thinking about water and agriculture and our trees. And then there are a variety of other ones, but consumer discretionary, we kind of coined that, and that's really how people vote with their dollars. And so, of course, you can think about that like reduced food waste, and also the EV trend.
Awesome. In our conference, excuse me, Method Man killed us. In the conference that we're doing next week, we coined this acronym AIR for what is impacting pricing in the capital markets due to climate change. And that acronym stands for adaptation, innovation, and regulation. And those three perspectives, or really almost waves, are hitting the capital markets all at the same time and driving pricing risk in the capital markets. So Rachel, since you started that, you look at a lot of this from a risk perspective, can you talk a little bit about how any of these three trends, maybe regulation even, are starting to impact the markets as you see it?
Well, from that standpoint that that social movements are giving us early indicators of risk, you can see it in much of the laws that are put into place and the various regulations that come forward. Just to kind of give you a quick example, forced arbitration for sexual harassment. It was something that really perpetuated sexual harassment. Adesina was very central in leading investors towards standing against that, where investors had actually supported companies having those policies. Ultimately, that became the law, that you could no longer have forced arbitration for sexual harassment, this policy that was bad for women in the workplace. But before that time, you could see that the companies who were eliminating those policies were actually doing a better job with worker retention. you could see that they were having more diversity, which is something that the market started to pay attention to in their leadership. And so what we find is that by managing the risk well, you get ahead of some of those issues. So it's not just regulation on our industry, it's also the broader picture of the laws that impact all of our lives. Something that you can be on the lookout for, the restaurant industry is particularly the publicly traded restaurant corporations are in a tailspin. They're having the worst staffing crisis. Part of the reason is because they're allowed to pay the sub-minimum wage. Social movements have been talking about ending the sub-minimum wage, which is a legacy of slavery, and it allows restaurants to pay their workers $2.13 per hour. So that's something that we've looked at in our portfolios and eliminated the companies that are perpetuating that unjust practice. And it's really a wonderful thing that you get ahead of that from a risk perspective, because then you aren't exposed to those companies in the post-COVID era where the job market is a lot tighter, for example. So I think it's both, like we're innovating in the portfolio, but on the regulation side, like look forward to the sub-minimum wage ending, and if you're investing in alignment with social justice movements, you will have been ahead of that trend rather than behind it.
Heather, there's a lot of talk today about ESG, and ESG
gave me the ESG question.
Yeah. It's why we came up with AIR as an acronym, because I don't want anyone to be able to do an anti-whatever I come up with campaign anymore. So I'm like, it's going to be really difficult to have an anti-AIR campaign. So that's why we use that acronym. But there's a lot of discussion about ESG in the political lens right now. But there's also a lot of misconception about ESG as an approach to addressing climate and climate itself being addressed by ESG. Can you talk a little bit about maybe where there are gaps between those two methods of looking at portfolio optimization?
Yeah, sure. So for us, ESG is more of a framework, and we use it as a risk framework. And you can, I think, apply it to any portfolio, any broad-based portfolio. If you're looking at more broad-based ESG, you should check out Stance Capital. I've got Bill sitting in the back there. But I think climate is more of a multi-decade secular growth trend, and also obviously a risk in all portfolios. And it's a little bit separate from the E, the S, and the G. Something else that I think people oftentimes don't realize is you can be focused on climate and it can be very environmentally unfriendly. If you think about solar farms, for example, there are a lot of trees that are being cut down to put out solar farms. And if you look at, for example, biofuels that people are talking about right now, it really matters where those biofuels are coming from. They could be coming also from forestry, or it could be coming from waste. And so not all climate solutions are created equal from an environmental standpoint or from an economic standpoint. And I think the same thing goes with when you think about what's going on from a social perspective. Actually, one of the solar companies just came out and got dinged for ESG because there was some slave labor in Malaysia. And so to me, ESG is definitely a framework for risk. And climate is, again, more of a theme that you can invest in from an opportunity standpoint, but still incorporate ESG if that's what you're focused on.
And yeah, I'd love to comment on that. So we see the broad umbrella of ESG is really looking at the risks and opportunities that are available in considering the environmental, social, governance, basically all of those essentially non-financial aspects that end up impacting the companies that you're investing in. And that's a bit different from values-aligned investing. Values-aligned investing is exactly as it sounds, like investing in alignment with your values. Both of those generally can include climate. If the values have a focus on climate, the E in ESG is directly about climate. Then there's the kind of third category, which is impact investing, and that's attempting to actually have a positive impact on the issue that you're addressing, and that's where you'll see a lot of the climate solutions show up. What's really interesting about this intersection, I've been giving you some kind of examples of early indicators on the social side. To tie that into climate, I'd like to share that one of the most important things that we get out of connecting with social justice movements is early indicators of risk, particularly in climate. Something that you can be on the lookout for, fossil fuels in the around 2014, 2015 was something that investors started to become aware of and organize to divest from. You're going to see a trend similarly toward divestment from extractive agriculture. So we'll be putting out a white paper and many other tools for investors to use, as well as we're already integrating it into our portfolios. But it's those same social justice movements that are giving us the early indicators. They're saying, hey, the people the companies that are putting the pesticides in the ground and poisoning us down in the Mississippi Delta, these companies are not only doing something that's terrible for these very similar marginalized communities, it's also something that's bad for the planet. And ultimately, whether it's through lawsuits or whether it's through regulations, there does end up being an impact on the bottom line. And you can look forward to that when it comes to extractive agricultural practices. It's something that we're just starting to get aware of. And so by paying attention to the people who are most impacted, you really do get that long-term risk advantage. And that goes whether it's for climate issues, racial, gender, economic justice. They tend to blend together, particularly because in a capitalist society, we've decided that certain groups take the hits, and it's the same groups over and over again. So the groups that are not doing well socially are also the ones that are most impacted by climate change.
Just to add to what you were saying, Rachel, I agree. Marginalized communities are going to be the most impacted by climate. I think it's something that not a lot of people are aware of or thinking about. If you just think about water scarcity, for example, or you think about coastal communities that are going to be affected by erosion, oftentimes the majority of that is through marginalized communities. And so that's another way to think about ESG as it relates to climate.
Heather, can you talk a little bit about your portfolio? Because I want to cover not just the issue, but also the fact that you're really doing public markets in a private wrapper. And just give us some idea of why you took that approach, even though it's a public market securities holding.
Yeah, that's a good question. So we decided to create a global portfolio initially because this is a global issue and there are opportunities globally. And so that's pretty important. Originally, it came from the institutional background, and I think that particularly with an LP structure, even though it's in public markets, you have the ability to invest in emerging markets and open in emerging countries, which you don't have as much of an opportunity to do, for example, in ETFs and mutual funds, where you have to use more ADRs. And so we think, even though this is an emerging market, is not an emerging market, we're overweight Japan, for example. So just kind of talking thematically about where we're leaning into, I talked a little bit about energy efficiency in buildings before. So you think about Japan, there are going to be a lot of building retrofittings coming up, and Japan also has a net zero goal to 2050, and there's going to be a ton of regulations around how those buildings are constructed. And so there are a ton of companies within that, one in our portfolio called Asbill, that are going to play into that theme. And you think about buildings, of course, there's, smart thermostats, things as benign as LED lighting, and insulation is really important, smart glass, building automation systems, and all of that needs to be put into those buildings to make them more energy efficient. And so that's one of the themes. I will say we believe in dynamically moving across themes based on where the economic opportunity is. Because all of the themes represent lowered emissions, but they're not all going to do well in the short to medium term. So, for example, we've been pretty structurally underweight solar, particularly residential, and some of those installation companies. They have a ton of debt on the balance sheet, and unfortunately, you were talking earlier about regulation. There's just a ton of regulation that's come down the pike for solar companies that's negative in the short term. As we're obviously all in California, and that's a big place where solar has been installed, and there have been some headwinds here. So I think, talking more about the opportunity set, it's good to be able to think about holistically where these climate solutions are and where they're most interesting based on the jurisdiction. So that's partly why we decided to launch the LP first.
Awesome. Rachel, you have an ETF that has been out for a while, and you also create SMAs. We've had the pleasure of creating jointly an SMA with you, so thank you very much for that, US-based SMA. But maybe you could talk a little bit about why ETF first, and then what is the difference between some of the SMA offerings that you have and the ETF that you offer?
Sure. If you haven't noticed it yet, we're looking at Adesina at more broad market portfolios. We're looking at the whole market, and our products are primarily meant to be a public equities replacement for your clients that have social justice values and want to incorporate some of those risks. What's really interesting is to pair a broad market strategy that's incorporating, looking at those risks, also with a more targeted strategy as well that can take advantage of the opportunities. And what we've found with that is that clients are very happy. They want to be they want to know that someone's looking out for them in the future, looking at the risks that haven't yet been priced into the market. And when we were doing our wealth management work, we were always pairing that broad market with the ability to take advantage of certain opportunities. But we started with that exchange-traded fund because a broad market strategy that covered all of public equities just didn't exist to that point. And since 99% of all of the asset management firms are owned by white males, we were doing something very different as well by being majority owned and staffed, including on the portfolio management teams, by women and gender expansive folks, Black, Indigenous, and people of color, and LGBTQ. What we ended up doing was taking a different perspective on a broad market portfolio. And so while there are plenty of broad market portfolios, that perspective from those people who had the ability to connect with the communities that are most impacted by racial, gender, economic, and climate justice was a brand new thing. Like basically, we were putting out the broad market portfolio that had not existed. What we found is that financial advisors, while they really enjoyed that, a lot of financial advisors like to choose, their allocation between U.S. And international. And so it became necessary to carve pieces of the index off in order to say, well, of that index, where we're replicating it with the ETF, of that index, we're going to just pull out the large U.S., for example, which you can get in the Gitterman portfolios. And advisors that really that are looking at managing the asset allocation in that way love the SMA products for that reason.
Awesome. So in the 24 meetings that I had over the last 2 days, also another reason why my voice is going, is a lot of the questions that came up from advisors was, how do I fit this into my portfolio? I think advisors that have been constructing portfolios the last 30 years get pitched a product by a wholesaler and say every time they get pitched, where do I fit this into my portfolio? And they're looking at climate as a piece that they fit into their portfolio. How do you, Heather, I'll start with you, respond to people that ask that question?
I don't know if I had 24 meetings in the last couple of days, but it was a lot. And I got asked the same question as well. It seemed that a lot of the advisors thought this was interesting in areas where they do have a broad-based portfolio, and kind of to Rachel's point, it could have that lens as well, but more broad-based, and then offering their clients something a little differentiated. I don't think that someone needs to be wholesale. I believe 100% in climate. I want this in my portfolio. I think that's one type of client. I think the other type of client is I have a broad-based portfolio and I want to engage in this as a growth trend. I think as soon as people begin to talk about it as not a trend, people get a little bit nervous and they're like, where are the returns? Am I going to lose money? And it's literally the opposite. There's literally trillions of dollars getting put towards this, and that's the conversation that you have with your clients, where they can get excited about doing good for the environment, but also growing their portfolio and growing their personal wealth.
Yeah, for those that haven't looked at this, the amount of money that the IRA bill puts to work in a green transition across many different sectors, from battery to EV vehicles to charging stations to green hydrogen, is more money than any government has ever invested in a single trend in the history of the world. And that's been inflation adjusted going back to the Great Wall of China. But even if you look at the internet, you look at defense during World War II, there's never been this rush of money going in one direction. And it will create some of the biggest companies in the world, because that's what large flows of money going into a trend like the internet in 1999 does eventually. So looking at this, even if you're hedging your bet, I have conversations every day in the South with people who say, maybe the climate's warming, but the climate does this for millions of years. It goes up and down. I point out that people weren't around when it did that before, so it didn't matter to people, and now it really matters, but they somehow missed that point, but whatever. I say, well, regardless of what you think is causing it, opportunistically investing in trends that are being funded with $1 trillion of investment just in the US, then look, of course, Europe, even China, Japan, pouring tons of money into solutions. It's just an opportunity that you can't ignore at this point. Rachel.
I totally agree. Yeah.
When people say to you, where do I stick this in my portfolio? How do you respond as the issues that you are so passionate about? Are they a piece of what you recommend someone does?
So for one of our advisory firms that has over $1 billion in assets, the Addisina ETF is actually the 90% of their public equities position in their model portfolio. So there are firms for which, if you have clients that are committed to values-aligned, impact investing, those are things that we're able to deliver, and it makes sense for the entire portfolio, as well as for firms where you just want some ESG exposure, where you just want to look broadly at the risks and opportunities. If you go deeper in the values, alliance, and impact realm, you're going to end up catching the basic ESG issues. It's a bit of a funnel. So for us, it makes the most sense to show up in an advisor's set of clients. We think of it as the advisor as a portfolio of clients, and we're saying, which of your clients cares about impact? Which of your clients cares about being values aligned? And which of your clients is more ESG? We're often a piece of the puzzle if their clients are ESG focused, and because there are other ESG strategies that exist, and we're a very particular one that's broad market based. But when it comes to values aligned and impact, like I said, we can show up as the vast majority of the public equities position.
What do you say to people that call what you're doing woke capitalism?
I'm saying you can call it whatever you want. I think that it's interesting. There's something fascinating that's happened with this anti-ESG movement. They're the same people that use the term woke capitalism. I'm like, you can call it whatever you want. Investors are never going to stop looking for the risks that aren't already priced into the market. And what we've found is an entire set of investable factors that hadn't yet been priced in, because those people, primarily that are most impacted by racial, gender, economic, and climate injustice, aren't connected to the markets. And so if you can get those risks priced in, that's just good for you as an investor. And I believe that long-term, our risk and returns really prove that out. And so you can kind of call it whatever you want, but the trend toward getting more information for investors is never going to go away. So I look at it more as like, this is more information. Yes, you can have an impact by investing with us. We mobilize investors to act together collectively on behalf of the organizations that are giving us the information about how the portfolio, the metrics the portfolio should be paying attention to. But even if you don't care about the impact, just having that incorporated is a huge value.
If I could just add to that, when you think about what is material, right? You talk about ESG, and I think that there's a lot of misinformation about it. But if just give an example of what's financially material in some of those letters. So as it relates to the environment, the demand for water, for example, has gone up exponentially just over the course of the last 50 years, industrially and also in households. And semiconductors, which is not something that people think a whole lot about when they think about the environment, uses up a ton of water, which is a risk for their business. Taiwan Semiconductor uses up a ton of Taiwan's water as an example. And so when there's a water scarcity issue, that leads to financial material risk for those types of companies. That has nothing to do with woke capitalism.
Yeah, also keep an eye on AI, because one of the things that's not being disclosed about AI is that the amount of chips that they need to do this really very high powerful computer modeling and running is driving demand for water up exponentially. There's some studies that have come out just in the last few days showing the increase in water demand of some of these technology and software companies that is unsustainable. So if you literally look at a company like NVIDIA and the amount of orders for chips that have come in over the past 12 months since AI has really become a hot button, those amount of chips that they're forward-looking on their sales projections would literally drain the water out of some of the cities where some of these companies are running. So it's definitely, it's like we've lived in a world for a few thousand years that we had an endless amount of resources to tap into. And through Keynesian economics, we got this idea that land and natural resources didn't factor into the economic model. And now we're faced with the reality that we are running out of some of these resources that are not replaceable, like water. And we have to figure out a way to bring nature back into the economic model to be able to live on this planet and keep it sustainable.
I'd love to just kind of add to, like, yes, it just makes financial sense, but for those of us who are truly committed to impact, it's been a little bit of a boon to have more critique of ESG. So many asset managers were kind of jumping on the bandwagon and naming certain portfolios where they might take a look at some of these factors. They were, naming them kind of in the broader ESG trend, but weren't really delivering. And so in an interesting way, for the asset managers that are really from top to bottom focusing on impact, you'll find that it's actually been wonderful to have some of the froth in the asset management market, ESG, kind of skimmed off of the top, because then our message doesn't get drowned as much. So in the end, it's actually been quite a positive, in addition to just making sense financially.
Yeah, I think probably what happened was large investment managers were getting asked about ESG specifically, and then they said, okay, what exactly do we have to say that we're doing to check this box? And then they're like, okay, what's the least amount of work that I have to do as a portfolio manager to check this box? Okay, great. And then who are we going to hire to put out a report to check this box? Okay, fantastic. And I think that's what has lended to a lot of the criticism, is just like box checking exercises and not real deep analysis around impact and financial materiality, which is really at the heart of what I think the conversation began with.
Yeah, years ago when they started claiming that ESG was a reportable alpha story, we were very outspoken that the industry was making a huge mistake, because all they were doing was taking ESG screen benchmark indexes, overweighting the high-scoring companies from one of the rating agencies and underweighting the low-scoring companies. And what that caused was an overweight in large-cap growth tech and an underweight in fossil fuel companies. That thematic weighting drove outperformance of those benchmark indexes over the pure index. And then they went out in droves, companies that put out these products, we won't mention names today, and they claim that ESG adds all kinds of alpha. And we were saying for years that the minute that thematic trade reverses, you're going to be having to defend the fact that ESG doesn't cause alpha anymore, because you framed it in a way that's incorrect from the beginning. And lo and behold, last year, fossil fuel industry outperforms, large cap tech gets killed. Now you see articles all over the place that ESG doesn't drive alpha, and advisors are getting scared away from it. It wasn't the story to begin with. ESG is a diligence methodology. We've become known for calling ESG the GPS of investing, which just means that you used to have an old map, now you have a GPS. Nobody runs around claiming that you're a woke driver because you're using your GPS over your old map that gives you a lot more data. ESG gives you a lot more data about the companies you're investing in. you'd be a fool to say that you didn't want more data about the companies you're investing in. That it just makes no common sense whatsoever. You could do whatever you want with the data. I don't care, honestly. But not taking in the data and examining the data makes no sense. You're in California, Pacific Gas and Electric. I mean, that was, I think, one of the best stories about ESG done wrong and right, because it was basically held in all the passive funds because it was high scoring, because it was converting the most people to renewable energy because of California regulation and the size of California. Active managers sidestepped it because it was self-reporting that its risk of fire due to droughts in North California were off the charts. There was no utility company in the country that came up on the risk charts anywhere close to Pacific Gas and Electric. And we all know how that story ended. Can you talk a little bit?
Yeah.
You can comment certainly on anything I said, but can you also add a little bit about what is your process of taking in this data? Because I know you're not using scoring methodology to screen out funds. How are you actually pulling in this data and using it to apply to your portfolio?
Absolutely. So, but first I would just like to comment on, this is one of the reasons why the focus on long-term sustainability for your clients' portfolios has to look at the intersections. You can't buy Tesla simply because what they're doing is good for the environment if they are, frankly, abusing workers. And particularly workers that are women and gender expansive, and they're people of color. So long-term, what clients want is a sustainable return for the future, and you're going to get that by companies that are prioritizing sustainability, not just looking at one of those aspects, but all of them. PG&E was doing great on diversity, and from a wide number of perspectives, and they were transitioning so many people to renewables, and they were basically not addressing the fact that they hadn't really done what they needed to do to mitigate risk in the rural areas where they had fewer customers, right? These are the economically disadvantaged folks. So that's why it really has to be this intersectional look at all of the pieces. So to answer your other question, what we do is we have over 40 different criteria, and that translates into over 80 different metrics or ways of measuring a specific issue. So for example, for racial justice, of course we don't want to be involved in prisons, but we're also looking at money bail involvement. So you can have multiple metrics. In our portfolios, companies cannot fail any one of those 80 different metrics. And when you have such a stringent process, you end up with companies that have been quite intentional, right, about what their impact is on both people and the planet. Those are the companies that are really going to last long term because they're working with society and with the planet. In a highly connected world, you can only kind of operate on an exploitation model for so long until folks find out. I feel like that's exactly what's happening in the investment world, is that the economics of extraction and exploitation are becoming known, right, in the broader world, not only to investors, but also to workers, right, and also to the consumers, and people are beginning to take action on that. So it's very important that companies are paying attention to this in a holistic way. And in building our products, we take over 13,000 companies that we start with, and we put them all through those criteria, those metrics. You end up with a very lopsided set of companies after that. So we apply a portfolio optimization algorithm that helps balance things out so we're not overweighted necessarily in certain sectors as a result. Because when you apply some of those criteria and metrics, you can end up with a very tech-heavy portfolio, which is something that ESG suffers from. And you need the investment expertise in order to understand that that's not a balanced portfolio and to make adjustments there.
Heather, you're starting really with the lens of what are the opportunities in this trend. Are you then also pulling in ESG data and applying it to helping and select companies within those themes and trends?
Yes. As I said before, we're using ESG. It's at the end, and we use it as part of a risk framework. And we may choose to either engage with the company or exclude the company altogether if it's in the bottom quartile. What we decided to do, since we're focused on the opportunities, specifically climate solutions, is we really think it's important to use a science-led framework. And so For those of you who are interested in learning more about climate solutions, I think a great science-led organization is called Project Drawdown. And we partnered with them. They have a list of 100 companies, and there's also Crane Tool. And we aggregated them together, and there are about 300 climate solutions out there, but not all of them are impactful today. So we very much care about what can lower emissions today versus tomorrow. We believe in the time value of carbon. And so we whittled those climate solutions down to about 100 that we think are economically viable and currently impactful today, and then mapped those solutions to 3,000 companies, which is our starting place for a universe. A lot of climate strategies out there have repurposed their strategy and are calling it climate, or they're using the MSCI All Country World, or they're using the S&P 500, and we just don't think there's a reflection of actual opportunity through that. So for example, our universe of 3,000 names, only 200 of those are in the MSCI All Country World. And it does end up skewing to different things because we're focused really on the opportunity. It definitely skews in many ways to industrials and utilities, technology, so on and so forth, because we think it's important that this be a very pure play. And companies like Occidental Petroleum and Exxon, you could argue, of course, that they are scaling climate solutions with some of the things that they're doing, but we think that anyone can own that in their portfolio, and so we've kind of chosen to exclude that because we don't think it's necessarily material to their business. So just kind of going back to ESG and materiality, something that we very much care about is how is this material to the company's business? Is it through growing revenues? Is it through current revenues? And we also look at R&D and capital expenditures to make sure that the company is actually committed to the business and it's not just greenwashing.
Awesome, thank you. If you want more information on how we think capital markets will be impacted by climate change, there is a white paper. It's a pretty long one on our website. You can download it for free at gittermanasset.com. It's called The Great Repricing Paper, and it was written with a lot of large asset managers, mostly European-based at the time, but that really showing the different ways that impacts of those AIR, adaptation, innovation, regulation, legislation, litigation, are going to impact pricing across the capital markets. We have about 7 minutes left, and we apparently don't have that system for asking questions online. I don't think it's working, or they don't have the person today that can do that. So I'm going to open it up to questions. If you're in the back, just please come up to the front so we can hear the question. I have some if no one has any.
Or
but
just
it looks
be really
like
loud. We'll repeat the question.
Yeah, it looks like an eager group, so hopefully some of you have questions out in the audience. Yes, in the back. Oh, there is the mic. Look at that.
Oh, thank you.
Thank you.
I have a daughter who just graduated college, and she's getting into something LCA, like life cycle assessment and stuff. You guys probably, you know, the whole process from start to finish of resources. What do you know about, or elaborate on a little bit about that, if you think that?
Are you talking about the circular economy in particular, like supply chain transparency?
Yeah, I think there's other names for it. I have all the companies have like these. They actually have jobs in these areas, but it's taking a resource from the ground. I know there's other names for it, and like all the way through to where it's disposed and recycled. Yeah.
Yeah, I would say that's super important. Supply chain transparency is very important. Talking about life cycle assessment, to us, that's probably most appropriate in the circular economy. So thinking about, rather than what's usually happened, we talk about scarce resources. You dig things out of the ground, you use them, and you dump them. And that actually creates emissions, and it creates more scarcity. And so doing a life cycle assessment, you think about all companies, how are they building their products? Are they building it to be recycled? So a huge trend, for example, in climate is battery recycling, right? There are all kinds of prototypes that are being developed so that in the EV space that batteries are being recycled and reused, because we do have scarcity in lithium, for example. And so circular economy is huge. We own a company in the portfolio that focuses on recycled metals, as an example. And so I think that's going to continue to be a real driving theme as it relates to all products and services. And we haven't even started talking about plastic, which I think is a a can of worms maybe we do or do not address today. But I think that the circular economy is just all about continuing to create profitability while reusing the same materials and assessing it all along the path to ensure that that's being considered.
Thanks. Next one. Oh, behind you? Oh, all right. Yeah. Stay there.
Rachel, I have a question for you. What made you decide to move out of wealth management and advising and move into the asset management space?
Ooh, that is a long story. But the short story is that the kind of wealth management firm that we had was one that worked primarily with women and gender expansive folks, queer couples, and people of color. And they all cared very much about their impact on the planet and on people generally. And we noticed that the investment options only began getting more and more diluted, and that our portfolios that we would build for them were only ever as good as the asset managers' offerings that were out there. And they were only getting more and more diluted as the world transitioned, or as the investment world transitioned to ESG. And so what we did was took a close look at, okay, like what's causing this dilution? Most of it started, the trend for the former socially responsible investing becoming ESG really happened after the Great Recession, where the only positive returns were in hydraulic fracturing in North America. And the asset managers that were, SRI focused were very concerned that they didn't have exposure, so they started to change their standards for what it meant to be socially responsible, choosing best in class. And we and our clients were outraged. How did Occidental Petroleum end up, in their Vanguard fund that was supposed to be focusing on doing well and also doing good in the world? So we really started it off as a strategy for our clients to meet their needs because we couldn't find other fund managers that were doing it. And it quickly became more popular even than the wealth management business. We actually had financial advisors coming to us saying, can you do this for our clients? And so over time, it basically became the impossibility of running two businesses. So we transitioned one, we sold one, and used that to further the growth of the other.
Thanks, Rach.
There's been a lot of buzz about the sort of Finland BlackRock ETF work. What do you say for folks who look at ETF as a particular product that can meet the interests of institutional investors looking for climate? Do you think it's, what you're talking about sounds so much more holistic than one product. So what do you say to the buzz around those types of deals? What do you think it takes? Is it having the best ETF in the market? Is it more holistic than that?
I just want to jump in, and then you guys can take it. When we do due diligence on the investments that we'll include in our portfolio models, and we run portfolio models for direct to clients and for other advisors to use, our due diligence goes up through the company that is making that product. So a lot of people stop at the product with their due diligence. But ultimately, if you want to own that product for a long time, you better know what's behind the product. So we look all the way through it. What is the company's standards on employees, on how they're dealing with gender issues on boards? How are they voting their proxy statements? And I don't have to publicly shame anyone, but you can track in the news anywhere what the proxy voting standards of BlackRock and Vanguard and State Street have been on those ETFs that are holding now more money than any government. I mean, it's an incredible amount of wealth controlled by those three companies, and they're not doing anything to get the companies that they own to actually keep moving forward.
Thinking about, I completely agree with everything that you just brought forward. Thinking about the ETF business kind of in general, for emerging managers, newer managers with a newer idea, the reason that we chose to go with an ETF structure is because it lets you avoid some of the pay-to-play aspects of mutual funds. And just quite literally, I don't come from wealth. And so there was no way I was going to have $50,000 to pay to get on a platform. What we had to do was trade similarly to a stock. and have the advisors that we were working with understand that as long as we weren't blocked from them having access to us, it was something that was going to work. I think that it's different, that consideration around do you go ETF, do you go fund, et cetera, than when you're looking at the BlackRocks of the world. They're really looking at like, how can they reduce costs and get that internal expense ratio as low as possible, and they really are able to do that with ETFs. And so I think the consideration of it kind of depends on where you are. I think this race toward cheap ESG, you end up getting exactly what you pay for. If you haven't really put, and we actually have an article on our website that's specifically about that, if you don't really put the resources toward it, if you engage in the process as an asset manager that Heather described, okay, what is it that we have to do? What boxes do we have to check? That was great. If that's what you're doing and not putting any more resources toward it, just kind of going for the lowest expense ratio possible, you're going to end up with greenwashing ultimately.
So follow us all on LinkedIn. We all post a lot of stuff that's super helpful and educational. I want to thank everyone for attending today. I want to really thank Heather and Rachel for doing a great job. Please give it up for Heather and Rachel this morning.